Bloomberg Money.
Good noon, everyone. Bloomberg Money on personal finance, on retirement, on wealth management, and also on the American job economy. Yes, Michael McKee will be with us. We'll get to that in a moment. I thought it was a sleepy Friday. That jobs report was a wake-up call.
It woke everyone up, including, I'm sure, this administration, because we got a negative print, which was completely out of the blue.
Have we recovered from Michael McKee's interview with Kevin Hassett?
I don't know if Kevin Hassett's recovered.
I don't think Kevin Hassett's recovered from it, but a lot going on here and across personal finance and retirement. There it is, but to me, and the theme I've had from listeners and viewers through the morning, is the two Americas out there facing retirement.
Absolutely, and with inflation becoming a bigger and bigger story, it won't go away. That has all kinds of implications for how you save, how you invest.
I got to tease this out right now.
Please.
We're golfing today.
Yes, we are. Professional golf.
We're professional golfing. Discuss. What are we going to be doing?
Rolapp, he's the new CEO of the PGA Tour. He will be joining us. But before that, we've got Meredith Whitney of Meredith Whitney Advisory Group.
We're thrilled to have Meredith with us here. She's got real different views on the credit cards that are out there in banking. And I do want to review one of her ginormous successes of all time.
All right, and we're also going to check in with Chief Global Strategist of JPMorgan Asset Management, David Kelly. He'll be speaking with us on whether getting inflation down to 2% is even possible and how you manage your savings as a result of that.
And then we go do the golf thing.
And then we do the golf thing, yes.
Do you play golf?
I've tried, and it has not gone well.
That's exactly. We have something in common here on Bloomberg.
Rolapp coming up.
Let's go right to the data right now on equities, bonds. Equities lifting off the jobs report. We'll get a nice sum of that from Mr. McKee here in a moment, but a nice lift to equities here. And what's really changed, Scarlett, in 48 hours, the VIX finally broke down to a bull market statistic.
Yeah, it's below 15 right now. All right, so stocks are flying. The bond market is also up, especially at the short end of the yield curve, although it's given back a little bit of those moves. The dollar is lower, down 1/3 of 1%, and it's a down week for oil, even with oil prices currently up about 1.5%.
Got a great set of Bloomberg people to be with us. David Gurl just won't go away. I mean,
no, we pay him to come
Bloomberg
in.
This weekend on Friday, ramping up to the show. Do you have a key guest this week?
Yes, maybe one from Michigan. I'm going to tease that.
Okay, we'll tease that here in a moment. She's a song with us. Thank you so much for joining. Nice to have you here. We've got lots to talk about. But the star of the show right now, how did you affect Mr. Hassett here? You were talking about socialism and the new Democratic Party.
Well, we were talking about some inconsistencies maybe in the Republicans' language. They have talked about the communist, socialist Democrats, and I asked him what a socialist was, and he said the government owns the means of production, and I pointed out that the Trump administration has been taking stakes in a lot of American companies.
John Edwards years ago was old school, and what I saw today was a two Americas job economy. Have you ever seen it, Mike McKee, this split apart as we all struggle to retirement?
I don't think it was too split apart this time. It was a lot of stuff under the hood that you have to kind of thread together to make a story out of it. Now, we did lose 23,000 jobs, but 50,000 of those were local education teachers and education workers, and a lot of that may be just a seasonal difference of when people were taken off payrolls, because they usually come off May and June. And so that'll go away in the next month. And then the question is, where's the rest of the job?
I'm not used to these.
We lost 19,000 retail jobs, but the rest of it was all just kind of lower hiring. Social services and education and health has been the big job creator, and we've been usually getting 30, 40, 50,000 a month in that category. Only got 22,000. So hiring slowed down, but we had a 4.1% unemployment rate because a lot of people left the labor force. Labor force was a lot smaller again for the second month. And what that's telling you is that the president's deportation plans are working. The baby boomers, except for Tom, are retiring.
Hey now.
And
as he looks behind his shoulder.
Last time on the show for him. Save the show right now, please, oh young one.
So the jobs report took inflation off the front page, at least for this morning. But when it comes to inflation, it's still about oil prices, David, and consumers have the Iran war fatigue. Every headline on military strikes or talks causes huge swings in oil prices and gas prices. It's really difficult to know where things stand. I think even the president has Iran war fatigue.
I think that's true. I mean, he's been talking about the prospects of a deal, but it's one that's being negotiated between the Iranians and the Omanis, and a very circumscribed one that doesn't involve certainly the nuclear program or anything like that. Interesting to see the way in which the president, if not talking about the Iran war, isn't pivoting to talking about the economy, although we do know from recent reporting from Bloomberg and other outlets, he's calling up Kevin Warsh, calling up the Fed chair more frequently now to talk about the economy, spitball his ideas of where things are, hear about Mr. Warsh's impressions of the data. So clearly cognizant of where things are, but that's not manifest in the way that he's talking about it on the campaign trail.
Is it odd, David, that we're ignoring affordability, standard of living, paycheck to paycheck right now? It seems like nobody's talking about it.
I wouldn't paint that with a broad brush, but I'd go back to the White House, and it is something that I think President Trump's advisors desperately wanted to talk about more in the advances that he's made. And you saw him go to Las Vegas this week to talk once again about no taxes on tips, which was such a rallying cry during the campaign. But it is not something that he is either fond of talking about or able to talk about or able to stay focused on when he's on the campaign trail. So I think that it is laid bare for so many people. You mentioned oil prices. Gas prices incredibly expensive. I think there's an awareness of the fact that that is the case here across this country, but it is certainly, to your point, certainly not in the Republican zeitgeist, the president's zeitgeist. You look at the election that we had in Michigan this week, it really was an animating issue. And even when you see kind of invective put on the candidate who won, on Abdullah Sayed, he pivots very quickly to talk about affordability in healthcare and other matters.
So it's because of this that investors kind of take matters into their own hands. And Zija, you've written a story about how artificial intelligence is helping retail investors become kind of DIY hedge fund managers. They're using this technology to build programs to generate huge returns in the stock market because this is what they see as their path forward.
Exactly. If you think about kind of the progression of retail trading, this is almost like zero commission 2.0. So 10 years ago, when Robinhood kind of spearheaded this zero commission period, and then during the pandemic, we saw like GameStop and meme stock trading, and now it's almost the next chapter for retail trading. Especially with artificial intelligence, these folks that we talk to, they don't just ask AI like what stocks to buy. They're asking them to help build code, build a model, very sophisticated model to help them identify strategies and even generate trading calls.
Okay, so on the one hand, this empowers individual investors, but on the other hand, everyone is using these AI models, which kind of look through the same data.
Exactly.
And they use similar models, and I would imagine spit out similar outcomes. Doesn't this create, concentration risk where people pile into the same positions?
For sure. If they're using the same AI models and generating similar calls, that could really amplify the market swings.
Those are calls. Does AI tell you when to get out?
It does too. Some people have set up, for instance, 10% stop losses so that they
we used to do that. We didn't need AI.
But if you're trading at a high frequency during the day, when you're at your day job or when you're having lunch with friends or even when you're sleeping, these AIs can actually execute or automate your strategies for you.
I want to bring back to jobs for a moment here. Mike McKee, did we see any evidence of AI, the kind of stuff that Zija was talking about, taking away jobs so far, or is it still too early to look for that?
Too early to look for that, but we did see evidence that AI is adding jobs because there were 22,000 construction jobs added, and about 19,000 of those were in areas adjacent to building AI data centers, non-residential construction, specialty contractors, and things like that. And then you had another 4,000 to 6,000 jobs in computer and semiconductor manufacturing. So those were some of the positive areas in this jobs report, and they're definitely linked to AI, but too early to say. Well, I didn't look at the actually jobs for stockbrokers, but too early to say that AI is having a big effect on them.
Red Sox just keep it going this weekend?
Every day I say they can't keep this up,
They
and
can't
they
keep
do.
this up, but they do.
They do.
It's
It
just
reminds me of Butch Cassidy and the Sundance Kid when they're looking back at the Pinkerton detective saying, who are these guys?
We do. It's amazing to see. It's been a joy, joy, joy of the summer. All of you, thank you so much for being with us today. Gura, McKee, and Song, thank you so much. All of them at Bloomberg here. Coming up, what a joy this is going to be. Meredith Whitney, definitive, truly iconic. A good number of years ago, still at Meredith Whitney Advisory Group, with some sharp opinions on your personal finance and your bank. It's Bloomberg Money.
You know about Pays?
Pays, yes, I do Pays. I like it. Bloomberg Money on a Friday, and I'll tell you, it's hot out there. Is it 90 today?
It feels like
yesterday was brutal.
I know. I mean, these are the dog days of August.
It's truly the dog days of August, and what we're going to try to do is have some good conversation here about personal finance, about retirement, and about everything out there in wealth management. Here's what you need to know. Meredith Whitney knows it's about baseball. In baseball, you go up to the plate, and 2/3 of the time, you go back to the dugout. She has enjoyed over the years a few times of putting the ball in play, definitive in finance, in banking, still Meredith Whitney's advisory group today. What was it like, the acclaim you had? I'm going to call it 15 or 20 years ago. How did you handle just the day-to-day vavoom of Meredith Whitney, municipal finance and banking? How do you handle it day to day?
It was really awkward because, my world had been really small, covering banks and financials, and I loved it. So people within the industry knew who I was, and I had great relationships. And then all of a sudden, there was so much more attention focused on me, and it's uncomfortable. I wasn't used to it. I can't imagine how you guys get used to it. It was a long time ago.
But you perfectly decide what you and Sally Krawchuk were path-breaking on, which is actually doing securities analysis. And then it got so much bigger than that. Let's show one of the huge Meredith Whitney successes. You got to play, you got to put the ball in play, and then you have to have the courage to hold on. I was in a meeting with Meredith ages ago. I could barely shave at the time. And, there we were, and she says, this company, Visa, it'll work out. When did you sell Visa? When did you get out? How did you not sell Visa?
I mean, it's just been, back then it was just, cash to credit. There was this huge tailwind to it. And also it was like, I call it a demutualization from the bank. So it was a straight arrow. It was one of the easier ones. And I call it the OG of fintech, because it was really one of the first fintechs. Mm-hmm. Now, after the financial crisis, the fintechs became a real thing and disintermediated a lot of the things that banks weren't willing to do because they had PTSD from the financial crisis.
Right.
You say Visa, I think about credit cards, and I know, Meredith, you track consumer credit as a way to gauge the health of consumer spending and therefore the broader economy. Your view is that it's become increasingly more valuable because of the way that people use credit cards, their Visas, now as opposed to 5 or 10 years ago. What does that look like?
Well, what's happened is post-financial crisis, the banks pulled back dramatically from near prime and subprime. So they had all sorts of exposure. Wells was a big subprime lender. And so all of that has moved into the shadow banking system. Even companies like that were famously subprime, like Capital One, has pulled way back and is focused on prime. Mm-hmm. So instead of revolving balances, people are spending and paying back monthly. Now the balances don't reflect that. They grow, but they're growing at the pace of inflation. And so what I look at as being a very good guide for where inflation is. And when gas prices peaked in early May. Mm-hmm. Credit card spending had already peaked in early April. And you've seen credit card spending decelerate from that time. And so these are just people spending, absorbing the higher prices, and then just spending accordingly. So I think the Fed should look at their own data. This is data that comes out weekly, so you can see credit card balances, and it's really helpful. So I think inflation is in a rearview mirror.
So it's like a charge card as opposed to a credit card that you pay the balance off of.
That's exactly right.
Okay.
The charge plate. You're
Right,
paying
right.
it yourself.
But that's also why all these big banks are chasing the higher income consumer. Everyone's coming out with their own premium credit card because the fees are so lucrative. I mean, there's an underserved population here of people who actually need credit cards but can't actually get it.
Can't get it. And so what they're doing is they're going outside of the banking system, which means it's incredibly expensive. I say that people aren't living paycheck to paycheck, but payday to payday. So the fastest growing industry within fintech and financial services is advanced wage pay. So if you've worked 2 days, you can access for a fee your wages for those 2 days. And what happens is people are using this service multiple times. Now, it was Dave and Chime that reported yesterday that it was their fastest growing product. And so while on a 2-week basis, it looks like a 6.5% interest rate, but annualized, that's over 160%. People aren't using this product one time, they're using it multiple times.
It harkens back to our grandparents. It feels like it's almost, depression kind of. It's not about fancy personal finance and retirement. It's about a tough time out there. We're trying to get to the next paycheck.
That's exactly right. So there was a study done in February that 2/3 of people working are living paycheck to paycheck, and a quarter of labor force participants are struggling to pay their bills. And so what they're doing is they're going to pawn shops, they're doing payday earned wage access borrowing, and they're tapping into, for the subprime and near prime, they can't even get home equity loans. So this is a feast.
Well, this is the courage you had over decades, talking about the two Americas out there. Help me out as a stereotype of James Dimon of a small bank on Park Avenue and buy now and pay later. I mean, to me, it's almost a revolution where the kids aren't using the charge cards like they used to. In our personal finance, does a firm and those kind of companies, do they win?
I think the buy now, pay later replaced the credit card. And what I never saw coming was the fact that the merchants are paying the fees, right? They're paying a firm, they're paying. And so what happened in 2010, and not to get too technical, but the Card Act.
It's Friday, don't get technical.
When we were in college, we got solicited by every credit card out there.
Yeah.
So when we graduated, we had credit card debt. In 2010, that changed. So unless you got a co-sign by your parent, if you were under 21, you couldn't get a credit card. So this generation of Gen Z and younger millennials aren't used to revolving credit. So they're actually buy now, pay later is more appealing to them, even though sometimes it's the same thing.
How do they set up a credit history then? If they eventually, when they want to start becoming consumers in this economy and be able to apply for loans, they don't have a credit history then.
That's exactly right. Because you're not, even if it's the high-end, high earners, and they're taking American Express, they're paying down their balance. So you're exactly right. It's going to be harder for them to get a credit history.
I think of you and the Klan. I'm going to pick on Mike Mayo. We all love to pick on Mike Mayo. Great analyst out there. You people said they'd get through the great financial crisis and that we should own the banks as part of our retirement. Give us an update now on where you think in the next 10 years those successful investments, where do they go?
Well, it used to be the case that the banks paid rich dividends. That hasn't been the case. So banks have been buying back shares at really high valuations, which is not accretive for the banks. And they've been reticent to raise dividends because they don't know how long this great earnings bonanza that the banks are in is going to last. So I think they're better vehicles to buy outside of the banks that have rich dividend yields. In retirement, you can have both. Equities that have rich dividend yields. Bonds are less certain. The 60-40 portfolio hasn't been a great performer the last year. But I think banks, JPMorgan is an absolute outlier. I mean, since 2010, they've just been a juggernaut, and that's been a great stock. But they bought back the most amount of shares of any of the banks.
20 years ago, banks were what tech was in terms of concentration in the market.
Yep.
I mean, they were the giants, and then now it's all tech firms. And banks are kind of like, middle of the road.
Can you see Meredith in the golf course? It'd be like a terror.
All right, stay with us. We're not necessarily going to talk about golf, but we do want to get your sense of how you manage and you look at your personal finances. Meredith Whitney is CEO of Meredith Whitney Advisory Group. She's sticking with us. And later on, speaking of golf, our exclusive interview with PGA Tour CEO Ryan Rolapp. Do you play golf?
I do.
Ah.
Yeah, I do. But
What's your
famously, I have the highest handicap you could possibly have, so I can play in tournaments.
That's better than me. They just tell me to get off the course.
But I invariably get this look with people behind me, because they're like, you got to be.
Bloomberg Money, welcome back. Tom Keene. Scarlett, I bought SpaceX. I sold it all at 106. It's popping 129 right now.
Well, you can get
it's
back
really
in.
worked out this week.
All right. Meredith Whitney is with us here. She's CEO of Meredith Whitney Advisory Group. You've made some big calls on banks, on munis, in your career on Wall Street. What's your personal approach to investing these days?
I've always been thematic with my approach. I didn't own the banks back then. Thank goodness, because I was covering them, and I just felt there was always a conflict of interest. But I always take long-term, thematic approaches to my investing. So I'll give you a couple of examples. The winners and the losers. With the housing bill, the affordable housing, 21st century road to housing, I bought Sky, which is Champion Homes, which is a manufactured home builder. And the idea is they repealed a chassis law. Things would change, that production would increase dramatically. And manufactured homes are really nice. They're not the manufactured homes of yesteryear. So I buy that. I do some frontier investing in terms of with
Certain markets, geographical markets, you mean?
Well, with a lot of the stans, which have very rich rare earth minerals, so that a lot of that is going SOEs, private to public companies.
Okay.
So I know that's sort of esoteric, but those have been good plays, and the emerging will be bigger plays.
All right, so a commodity play there then from Meredith Whitney. Thank you so much for joining us, by the way.
Thank you.
Really appreciate it. Meredith Whitney, CEO of Meredith Whitney Advisory Group. Coming up, a conversation with David Kelly with a focus on personal finance, retirement, and wealth management. This is Bloomberg Money.
Meredith. Bloomberg Money on a Friday. We're talking golf. No one on the show so far except Meredith golfs.
I know.
We ought to get a life.
Our score would be just like sky high. It'd be ridiculous.
It would be good. But it's fun, and I'm really looking forward to this. This is the PGA we're going to be talking to.
The PGA Tour's new CEO, Brian Rolapp, will be joining us. He was appointed to the job about a year ago, and he officially became the CEO this summer.
It is nuts. It's hugely political right now.
Yeah.
It's not just about moving the ball down the course.
No, there's live golf. There's all kinds of things involved.
Let's go to market check here. It's on a jobs day. Thank you, Michael McKee, for staying late to really help us out here with a better look at the jobs report. In the stock market, guess what? It's green on the screen. It's pretty much what it was before that shock employment report. What's of note to me, the VIX, 15.04. That's been 17-ish, and it really broke down in the last 48 hours to a 15.04. This is fun, and it goes way, way back. David Kelly runs 30,000 people for Mr. Diamond and Ms. Erdos at JPMorgan Asset Management. It is truly of a global reach as our chief global strategist each and every day, grinding it out. And the foundation of how he does that, he and I go back years. There was a guy years ago who was the king of the glass is half full. His name was Bob Goodman, and in the Malays at Putnam, at the Malays years ago of America, he said, get on board stocks. And you've always been a glass half full guy. Are we half full right now?
Certainly in the stock market, we're half full. I think that the stock market is more than half full. The economy, if you look at what they used to call the misery index, sum of inflation and unemployment, it's actually, we think that for the month of July, it's better than it's been 75% of the time over the last 50 years. But if you look at consumer confidence, it's worse than it's been about 98% of the time. So it certainly doesn't feel like, it is more than half full, but it actually feels like it's worse.
Back when I first met you, I think there was just a Bloomberg terminal. We lived off the value line, which is a big, thick book, folks, that we tripped over once a week. Are we doing asset management worser now because of the media? Because of the frenzy of social and the speed of information?
I think we still have the same sort of challenges. I mean, there are things that we do better. I think there are more solutions out there for investors. I think people who get good advice can do very well. And it's been a wonderful stock market for many, many decades. I mean, if you go back to the last 40 years, we've averaged over 11% in the S&P 500.
We did not see that coming.
Years. No, at no point over those last 40 years would you have said 11% is a normal return. So that much has been good. I think the products available is good. Where I think we've got problems is people are being fed such biased information and such confusing information from both sides. I mean, that it's very hard for people to get a good, balanced sense of where the economy and markets are.
The last time the S&P 500 rose for more than 3 straight years was 2007. There was 5 straight years of gain. So it feels like something's going to give at some point. But the policy from this administration suggests that things will keep going.
Well, I think we need to recognize that over the decades, there's a reason for that 11% return. It's because over the years, the game has kind of got rigged in favor of the stock market. We've gone from defined benefit plans, which are kind of balanced, to defined contribution plans, which are just all in stocks. But over 80% of the assets are in stocks. We've got $1 trillion of stock buybacks last year. Just for the S&P 500 companies, $600 billion in dividends. All that money is going to the stock market. And we have a very K-shaped economy. And that's not very good for people selling to the broad mass of consumers, but it's very good for those who are essentially the beneficiaries of the spending of the very rich, because what do the rich do? Well, they buy stocks and bonds.
Right.
And that's been pouring money into the market. So I think the market is really outperforming the economy by a lot.
You mentioned the K-shaped economy. Scott Bessent, this Treasury Secretary, denies that the U.S. economy is K-shaped. He says it's more of a C-shape, pointing out that there's been wage gains among the bottom quartile of earners picking up. You mentioned a misery index. It feels like wage gains is a new misery index.
Well, I think the thing is that if you look at, first of all, I'm not sure where he's getting those data from. So I think we need some clarity there. But if you look at the growth in production, non-supervisory worker earnings, and then you look at all wages, they're going up at the same pace. So there is really no gap there. But where there is a gap is if you then go away from wage income and say, okay, how about dividend income? How about capital gains? It's clear that people at the top are doing much better than everybody else. Right. And the other thing is that, if you look at this morning's employment report, basically American business can't find workers and American workers cannot find a raise. We've got no job growth. We've had the labor force has fallen by 1.3 million people over the last year. Right. Wages are going to be below CPI inflation year over year for a 4th straight month. So workers are not getting a wage increase, and that bodes pretty ill for people trying to sell to the great mass of consumers, because if you don't have any more workers and they're not making any more money in real terms, pretty hard to grow.
And this goes to the hallmark of what we're trying to do here. Scarlett and I really agree that it's personal finance, but you know what? There's half of America flat on their back, and Mr. Kelly mentions that as well. Here are some comments from JPMorgan Asset Management. I think it's really important. Cash isn't always king. First of all, there's a 90% probability one person in a couple, is 65 years, they reach 85. Somebody's going out to 85. Since 30 years ago, a 60-40 portfolio has outperformed cash 1 month basis 65% of the time. And if you go out 1 year, 2 year, 5 years out, it's an absolute layup. Yeah. Why in God's name are we so much in cash?
Well, because I think we've got sort of a bipolar market. I mean, people are either they feel like they've got to hit a home run and they put it all into Bitcoin or meme stocks or whatever, or they huddle in cash. And it's because I think people don't understand that the whole point about investing is not to come up with the secret thing that's going to beat the market. All you got to do is latch onto the market. You make a few basis points here and there from good management, avoiding stupid companies. But overall, if you just bet on the forest, you don't have to pick their exact tree. But what happens is we've really got 2 types. We've got those who are just way too risk taking. Investing in Bitcoin or whatever. And then you've got a lot of people just huddle in cash because they're seeing what on the social media feed. And the social media feed is telling them you need to be very scared and you need to be very angry. And that is just preventing a lot of people from actually getting invested.
I want to talk about those young people who are going all in, going into Bitcoin, going into prediction markets. Do we assume that as they get older, they'll grow out of that mindset?
Oh, this is a key question.
Well, I think they can, and I think that institutionally we can help them out by just let's default, put some money into 401k. But I think it's also a matter of education. People really need to understand that it's Wall Street is not. I guess even if you look at all these terminals, you see all these numbers, all this confusion. It's not that difficult. It's about basically investing in American business, and if companies are making good money, they can pay that out in dividends or in coupons. invest them. It's not rocket science, and I'm afraid sometimes people think it is, and therefore they think they've got to have some really smart idea to beat.
On
them
Bloomberg Money, we avoid what's going to happen at Jackson Hole. What's the Fed going to do? But something we really want to know in each and every firm, and you're advantaged by Kasman, Ferroli, and the others, how do you use economics within wealth management, within retirement, within someone's personal finance?
Well, a lot of it, first of all, you have to figure out things like, okay, where's the dollar going, for example? If the dollar's been coming down for the last 2 years, if we think it's going to come down some more, that will amplify the return on international investments. Right now the US is 64% of global stock market capitalization, which is an enormous number. And yet almost all American investors have got less than 36% of the money in international. Everybody's underweight international. So, and if you think the dollar's going to come down, put some in there. And then also just looking at different sectors. We can see where these AI earnings are coming from. They are very impressive, but also recognize that there will be bumps along the way, and the market is very concentrated. People's portfolios have drifted into being very concentrated, so you have to sort of try to get more balanced.
What was it like when you're coming out of the gorgeosity of Dublin, Ireland, when you parachuted in Lansing, Michigan? What was the first day like at Michigan State?
Well, my mother had sent me over with a lot of Irish sweaters and blankets because she thought it'd be so cold, because she'd only heard about snow in Michigan. And I arrived and it was 90 degrees. So that was a bit of a shock to the system. But I will say this, that the rest of the world knows much more about America than America knows about the rest of the world. So people, when I got back the first Christmas back to Ireland, people said, what surprised you? And apart from the weather, nothing.
Interesting. David Kelly with us with JPMorgan Asset Management. I can't say enough about the arc of the career and what this is about. This is really important. I'm going to do my Twitter thing here for this weekend on this. It's real simple. You got to figure out first if you're glass half full or glass half empty. I grew up with parents that were both.
But
there was a huge tension there.
If you were not half full on the equity market, you would have lost out big time.
You would have lost, and that's a large part of America.
Yeah.
No question.
Once you get out, it's difficult to get back in.
The only reason Scarlett puts up with me is I'm glass half full. That's all there is.
Oh, he's glass half full all the way. Absolutely. All right, David Kelly, thank you so much for joining us. Really appreciate it. Coming up on Bloomberg Money, our exclusive interview with PGA Tour's new CEO, Brian Rolapp, formerly of the NFL. This is Bloomberg Money. We're not just about how you make and earn money, it's how you spend it.
It's going to be great.
You made money caddying? Bloomberg Money is about making and investing your money, but it's also about spending it. And a lot of people like spending it on golf, both watching and playing it. Professional golf only caught the attention of golfers for decades, but over the last 5 years, it's become kind of a soap opera. Bloomberg senior business of sports reporter Randall Williams joins us now. And Randall, I go to the idea that for people in the U.S., professional golf was equal to the PGA Tour. But then you had Live Golf, which was funded by the Saudi Arabians, popping up as a competitor. And then at some point, the two decided on a merger. But then I don't think anything happened. What's the latest, or what has happened?
Well, it's been on an indefinite pause. But the PGA Tour has evolved since then. Of course, Live Golf entered, it caused a lot of chaos. But then you had the Strategic Sports Group. That's backed by Fenway Sports Group. It's backed by Steve Cohen, who's the Mets owner. And then you have Arthur Blank, who's the Falcons owner. Them and a lot more people put up to $3 billion into the PGA Tour, which created a for-profit arm called the PGA Tour Enterprises. Since then, the PGA Tour has been slowly trying to, I'd say, recalibrate itself to get on the right track, to evolve, to fill in some of the holes that maybe Live Golf exposed.
What were some of the holes that Live Golf exposed? Because golf had a bit of a renaissance during the pandemic. Up until that point, a lot of people criticized it for being hard, elitist, expensive, but then golf found itself during the pandemic.
Well, I'd say that golf is very a traditionalist sport. And so with tradition, there's always tradition versus innovation. And so, of course, you had some people complaining about player pay. You had people complaining about the tournament schedule. And so now we have a bunch of innovations that are happening in regards to the system of golf. There's going to be a championship series, then a challenger series, and That's how the changes have come
What do you
about.
see TV doing here? I mean, the Masters is iconic and all that, but in terms of the entertainment TV streaming battle, are there going to be a huge bidding war from where you sit?
I think so. I think we're a couple years away from that, but media rights are, of course, a huge part of the sports business, and if you're not in the media rights business, then your sport probably isn't going to last very long. And the PGA Tour is still the dominant presence in golf. I think the threat of LIV came from the Saudis, who had seemingly limitless pockets. Now that that is not in existence anymore, the PGA Tour is, once again, the dominant franchise that I think broadcasters are going to be bidding on.
Yeah, with Saudi Arabia pulling its funding from that other golf league. Thank you so much. Bloomberg Senior Business of Sports reporter Randall Williams. Joining us now, I'm pleased to say, is the new CEO of the PGA Tour, Brian Rolapp. Brian, great to see you here.
Great to see you.
So we just talked about how golf is for the traditionalists. A lot of people like to say it's the sport most like life because it's hard, but it's also kind of elitist and kind of expensive. Coming from the NFL, do you see those as features to be protected or barriers to growth that should be challenged?
Well, I think any sport, professional sport, that's worth its salt will always sort of challenge where it is. And I think there's one thing I learned at the NFL over 2 decades is, if you're not going forwards, you're going backwards, and innovation matters. So when I first took the job, I was very clear that we're going to honor tradition, but we're not going to be overly bound by it. Mm-hmm. And you look at some of the trends of the game of golf, while, as you say, maybe it has this reputation as elitist. If you look at the growth since COVID, participation in golf in this country has grown 39% since COVID. Now, you don't have to play a sport to watch it on television, but sure helps. Half of that growth is under the age of 20 or 35. The average age of a professional tour telecast, inclusive of the majors, is 66 years old. So there is a disconnect between where the sport is going and what professionals have been able to do. We are closing that gap in significant ways, and if you just close that gap to a minimum, you've got a bit of a rocket ship.
You've talked about how LIV Golf helped expose some of the weaknesses of the tour. Was the biggest lessons about the economics of professional golf or about the product itself?
I think it's the product. I think, listen, there's something about the sports industry I don't understand if you look at the history. Huge innovation usually doesn't happen without a crisis. It could be a labor dispute with a collective bargaining agreement. Back in my old job, the USFL or the AFL, NFL, when I looked at this opportunity, I just saw the AFL, NFL, which essentially created a lot of systemic changes in professional football that started to accelerate the growth. I think we've had that moment here. So I think a lot of perhaps shortcomings in professional golf came with a little bit of competition. We're all Americans. Competition's a good thing. So I think we've seen that, and we're trying to build something that outlives all of us here.
What did you learn from Pete Rozelle? I mean, it was before your time.
Yeah.
If we say Pete Rozelle invented all of this, really best practices as well. What is if you're the Pete Rozelle of golf, what do you need to do to really jumpstart it?
It's a really good question. Pete Rozelle, I think, one thing he got, I mean, he was 34 years old when he took a job, and I don't think people realize that, but he was the first one who figured out media, I think, when it came to the NFL.
I agree.
So the modern media model that I think you see in the NFL that I was a part of, but then I think other sports have adopted, is if you get your media model right, you can build the sport. So when he started working in the NFL, it was probably the third most popular sport in the country behind professional baseball and college football. But because of a reach model using network television, he built the sport and told the stories. And so I think that's one thing I've learned is how, we're concentrating how do you increase the reach of the PGA Tour and how do you tell more stories about the athletes who play it.
Okay, so you got Arnie from Altoona, Pennsylvania, coming up the course, lighting it up decades ago. I was at Rochester in 1968 when Lee Trevino turned your sport upside down.
Yeah.
Who's your new Lee Trevino?
Well, listen, I think we have a lot of stars. I think there's a misconception about professional golf that a given competition or a given tournament only matters if 1 or 2 golfers are in it. When you actually look at professional golf, the difference in winning a tournament and losing a tournament is 1 stroke over 4 days. That type of competitive parity, it's that tight. The only other place I've seen that is in professional football. So the reality is we have a collection of some pretty amazing golfers, whether you take the established guys like Scottie Scheffler and Rory McIlroy, or you look at the Koiven kid who's just coming out of Auburn, and some of these younger guys who are just really performing well. I think we have an amazing roster of veterans and young guys who are really, really competitive. It's our job to actually showcase them better.
Randall was talking to us about the PGA Tour Enterprises, this commercial arm. Of course, FIFA wanted to follow the tour's lead and spin off its own business and seek outside investors. That ended up failing. I'm curious to hear more about the PGA Tour Enterprises and the role of it in the PGA Tour overall. Is this something that the players feel and experience? Is this something that the fans feel and experience?
Yeah, I think the answer is both of them will. I think the players experience it where what PGA Tour Enterprises has allowed us to do is to evolve the PGA Tour where most professional sports have gotten. We've actually capitalized it and turned it into a commercial business. And the strength of that commercial business funds innovation, it funds player purses, it funds everything. I think the PGA Tour was locked in a bit of a legacy governance model. Now that the mission is clear, now that we're capitalized, we can do that. So I think the players will feel it in that you look at the new competitive model that we've announced. There's healthy purses across the board, and they can actually earn equity in the tour. This is the only professional tour of scale that I can think of.
Right.
Players can actually earn equity, which is a huge opportunity and also aligns investors, management, and players like no other sport in the world. I think the fans will feel it because of that commercial change to the tour. We have investment dollars to make the fan experience better, to make the competitive product better, to make the media product better. So I think that is, and I think that's one thing that came out of this live competition and crisis is we got focused, we got capitalized. Now we know what the mission is. And I think fans and players are going to win because of it.
What are you personally going to do about slow play? There's no other, Meredith Whitney was just on with us, and she's standing on the golf course lining up a 5-foot putt for 20 minutes.
Yeah.
And the answer is slow play. The retires, we do personal finance, retirement, wealth management. Everybody in retirement wants to play your sport 4 days a week, but they can't because of stupid slow play. What do you do?
Well,
Clock?
I don't stay up at night worrying about slow play among amateurs at their country club. I actually don't care about that. Well, I only when I think about the PGA Tour, professional golf, I think it depends when we're talking about and who you're talking to. When you're talking about slow play on a Thursday or Friday round before the cut, when we have 144 players and it's early in the year and we're racing against daylight to keep this on television.
There you go.
We need to speak
Fascinating.
it up. We need to face up. When you're talking about a Sunday round or a playoff and someone's taking extra time to line up a shot because it's the shot of their life, that's different. So I think context matters here. I also think it's about how we produce the sport. So if you're watching it on television and somebody is actually standing over a putt a little longer, there's 1,000 other shots going on the golf course. It's our job and our broadcast partners produce it better. I come from the NFL where we produce the Red Zone channel. The Red Zone channel moved around. The fact of the matter is half the time when you go in to look at a Cleveland game, it's not live, it already happened. Yeah. Roll it back. I think we can produce it better and actually tell a better story. So it's a complex issue, but I'm not really focused on your local club. That's the local club's problem. I'm really focused on the PGA Tour.
Can you do a Red Zone version of the PGA Tour?
I think we could. I think we're talking about a lot of innovation, but if you think about how golf is produced already, it is a little bit of a red zone. Here's Scarlett on the 18th green. Let's take a look. Let's go over here and look at somebody else.
I gotta ask, do you need a hydration break? Please tell me. If the ninth hole, a hydration break was a Jenny Cream ale, but that's a separate story here. What are you going to do about a hydration break to bring in a marginal million?
Well, no comment on that. I'll ask the FIFA guys on that. I don't have a view on that.
Well, having said that, I'm sure you watched the World Cup. Are there any learnings from the World Cup, the spectacle that was the World Cup, that you can apply to pro golf?
I just think, in general, I think the World Cup or what we're doing, what other sports are doing, it's a reminder that the value of sports is increasing. In a world that is continually fragmented, whether it's by media, so much competition for your attention, there's a handful of things that are standing out that can aggregate tens of millions of people at one time doing one thing. And I think it's sports and maybe some news. So I think that is encouraging if you're in the sports business. Now, it doesn't mean you can rest on your laurels. It means you need to innovate and keep up with the changing demographics of the sports fan. But I think if the World Cup or anything has taught us is that sports is a pretty strong investment class.
Okay, when you innovate, especially when it comes to media distribution, it gets to the point where fans are left confused. We have a Bloomberg News story about how sports fans are looking at $2,000 streaming bills in order to follow their favorite team. Has it gone too far to the point where fans will start rebelling and it won't work anymore and we have to kind of rethink this?
Well, if fans are rebelling in sports, we haven't seen it yet. But I think the larger question is, while I'm a big believer that in order to build a sport, and the value proposition of sports and media is reach. How many people can you reach? How can you aggregate audiences? That is still true. Pete Rozelle got that right.
Right.
That is still the case. The difference is
Right.
reach is much more complicated because of where the media world is.
I got to slip this in. You have
Yeah.
a gift. He's at Florida State. I think he's 14. I don't think he can drive a car. Miles Russell.
Okay.
What do you do with a property like Miles Russell, who's 15? I think 15, 16 years old.
Well, I think what you're going to see is when we announce our new competitive model, which if you study what we've done is we've opened up the meritocracy of the PGA Tour. We've created a championship series, which is the top 23 events or so, where the top 120 golfers are going to compete together week in and week out. They can't play down into the Challenger Series, which is for everybody else. They will compete for a regular season title that will be the most prestigious thing in golf. There'll also be promotion relegation. So at the end of that you're going to be relegated down. My point is, we've opened up the meritocracy. So if he's that good, we have now created a system where he will work his way in to be into the top. No more sponsor exemptions, no more of the stuff that hit in the meritocracy. Where you play is based on how you earned it in the play. So I think that's important.
Brian, at some point, LeBron James will have a lot of free time. And we know that he's been playing a lot of golf, and he is an investor in PGA Tour Enterprises. Have you talked to Mr. James about some kind of role for him in professional golf? I don't know, some kind of ambassadorial role?
No, I haven't. But I think LeBron James is an example of the growth of the sport. Like when people get the bug, they get the bug, and it's a great competitive sport to play, but also to watch. And so we'd love LeBron to be more involved. We love everyone to be more involved, and I think you're going to see more of that over time.
Brian, thank you so much for your time today.
Thank you.
Great to have you in with us. Brian Rolapp, the new CEO of the PGA Tour.
Can you say LeBron in a sand trap and nobody else can see the tee?
True.
And he's just looking right over and he can see the tee.
And those deep bunkers on the links course, you can see over. Yeah, it's an advantage.
It's very cool to say the least.
That would make a very interesting red zone version of PGA Tour if you put that all together.
I'm excited about what I heard here. I mean, I think they're really, with the adversity of the last couple of years, really getting their act together.
Yeah, absolutely. Really cool. It's a big subject in terms of everyone spending all their time playing golf, watching golf, and spending money streaming golf and other sports.
It was an honor here to interview Lee Trevino a number of years ago, but just seared in my memory.
You were talking about caddying and how you made a lot of money.
I caddied. It was like 4 bags a day.
Really?
Yeah. Wow. I caddied at Oak Hill, where you had a wonderful tournament a couple years ago. It was great. It was a real learning experience, to say the least. I believe those have been buried.
All right, we're going to find a way to unearth those pictures. And that does it for Bloomberg Money this week. Tom Skeen and Scarlett Fu, join us next week. This is Bloomberg. Thank you. That was wonderful.
Sure. Happy to do it.
Wonderful.
Thanks for having me.
Wonderful.
Yeah, and especially for coming into New York.
Sure, I was here. It worked great. So
yeah.
It's easy.
Come back again.
I will. I'm here often. I still kind of live in Connecticut anyway, so I'm up here.
You're in Darien, I read?
Yeah.
Okay.